If you're over 60 and planning to leave a legacy, here's a number you can't ignore. The average American family loses up to $445,000 to estate taxes and fees, money that could have gone directly to your loved ones. Let me repeat that. Nearly $500,000 gone simply because of overlooked estate planning strategies. For many retirees, this is a devastating and completely avoidable outcome. The longer you wait to address your estate plan, the more you risk your hard-earned savings being lost to taxes, probate, and unnecessary legal costs. In my 3 decades of guiding affluent seniors through retirement, I've seen families blindsided by these issues, while the most successful retirees put simple, powerful steps in place to protect their wealth. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation. Past performance doesn't guarantee future results. Today, I'm going to show you the critical estate tax moves that can help you safeguard your legacy, potentially saving your heirs hundreds of thousands of dollars. By the end of this video, you'll know exactly what steps to take to keep more of your wealth in your family's hands. But first, let me share the single most overlooked detail that could make all the difference. Pay close attention, because what you're about to learn could change your family's future forever. Part 1. The hidden threat to your legacy. Estate taxes and the $445,000 reality check. Let's begin with a question I've asked thousands of retirees over the past 30 years. How much of your life savings do you want your family to actually receive when you're gone? Most people understandably answer, all of it or as much as possible. But here's the reality. What you want and what actually happens are often two very different things. In my 3 decades of working with affluent seniors, I've seen far too many families lose a staggering portion of their inheritance to taxes, fees, and legal costs that could have been avoided with proper planning. The numbers are sobering. According to the IRS and the most recent estate planning studies, the average American family with substantial retirement savings can lose up to $445,000 or more to estate taxes and related expenses. Let me repeat that. $445,000. That's not a hypothetical figure. That's real money lost from real families every single year. Now you might be thinking, that can't possibly apply to me. I've already set up a will. I have a 401k, maybe a Roth IRA, and I've paid my taxes all my life. Unfortunately, having a will or a retirement account is not enough. The U.S. tax code is complex, especially when it comes to estates. And the rules change frequently. What worked even 5 years ago may no longer be effective today. Many retirees find themselves caught off guard by the sheer number of taxes and fees that can erode their estate. Federal estate tax, state inheritance tax, probate fees, legal expenses, and even income taxes on inherited IRAs or 401ks. Let's look at the numbers more closely. In 2025, the federal estate tax exemption sits at $13.99 million per individual. That sounds high, but here's where many people get tripped up. If you own a home in a high-value area, have a healthy retirement portfolio, and maybe some life insurance or other assets, your estate can add up faster than you think. And in many states, like New York, Massachusetts, or Oregon, state estate taxes kick in at much lower thresholds, sometimes as low as $1 million. That means you could be subject to estate taxes even if you're nowhere near the federal exemption. Here's another critical point. Even if you avoid federal estate tax, probate costs alone can eat up 2% to 7% of your estate's value. On a $1 million estate, that's $20,000 to $70,000, just in court and legal fees. For larger estates, I've seen probate costs soar past $100,000. Add in state taxes, and suddenly that $445,000 figure doesn't seem so far-fetched. In fact, for many of my clients, it's a conservative estimate. Now, why does this matter so much after age 60? Because every year you delay addressing your estate plan, you lose valuable options. Certain strategies, like gifting, trust planning, or Roth conversions, work best when you have time on your side. The sooner you act, the more you can protect. But strategic planning timing remains important as you approach age 70 and beyond, especially with potential changes to tax laws looming in the next few years. Let me share a story from my own experience. A couple I worked with, both in their late 60s, believed they were fully prepared. They had a will, power of attorney, and thought their IRA would pass smoothly to their children. But when the husband passed away, the family was hit with over $320,000 in combined estate taxes, probate fees, and forced withdrawals from inherited retirement accounts, all because they hadn't taken advantage of key estate planning tools. The money they lost could have funded a grandchild's college education or provided a financial cushion for the surviving spouse. And sadly, this is not an isolated case. I've seen it happen time and time again. Here's another statistic that should give you pause. According to a recent survey, over 58% of Americans over age 60 have not updated their estate plan in the past 5 years, and nearly 40% have no estate plan at all. That means millions of families are at risk of losing hundreds of thousands of dollars unnecessarily simply because they haven't taken the right steps. It's easy to think, I'll get to it next year, or my family will figure it out. But every month you delay, you risk exposing your estate to new taxes, costly legal battles, and family disputes. The consequences are real, and they're permanent. Once those dollars are lost to taxes or probate, they're gone for good. Let me pause for a moment and emphasize. This is educational content, not personalized financial advice. Tax laws may change. Your situation is unique, and you should always consult with a qualified financial advisor for your specific needs. But the patterns I've seen in 30-plus years of helping retirees are clear. Proactive estate tax planning is not just for the ultra-wealthy. If you have a home, retirement accounts, and a desire to leave a legacy, you need to act. Now, you might be wondering, is there anything I can do to protect my family from this? The answer is yes, but most people don't know where to start. The most successful retirees I work with don't wait until it's too late. They take action, often saving between $150,000 and $445,000 in avoidable taxes and fees. And they do it using proven conservative strategies, not risky schemes or shortcuts. Industry insiders know that the true secret to estate tax planning isn't about finding a loophole or a magic investment. It's about understanding the rules, using the right tools, and acting at the right time. It's about making sure your assets pass smoothly, efficiently, and tax efficiently to your loved ones, instead of being siphoned off by the government or the courts. So far, we've covered the magnitude of the problem, the real risk of losing up to $445,000 or more, the complexity of estate and inheritance taxes, and the urgency of acting before it's too late. If you're over 60, the clock is ticking, and the choices you make in the next few years will determine how much of your legacy actually reaches your family. But here's what most financial advisors won't tell you. The standard advice, just having a will or naming beneficiaries on your accounts, is not nearly enough to shield your estate from taxes and fees. There are smarter, safer ways to protect your wealth and ensure your wishes are honored. The solution is simpler than you think, but most people get it wrong. In the next section, I'll reveal the core strategy that has helped my clients preserve hundreds of thousands of dollars for their families, and how you can do the same, starting today. Part 2. The core solution: building a fortress around your legacy with proven estate tax strategies. Now that we've uncovered the staggering risk of losing up to $445,000 or even more to estate taxes, probate, and unnecessary fees, let's shift our focus to the core solution that has helped countless retirees preserve their wealth for future generations. This isn't about chasing loopholes or taking unnecessary risks. It's about building a reliable, time-tested plan that protects your assets and honors your wishes. In my 30-plus years of guiding seniors through this critical stage, I've seen firsthand that the most successful retirees use a combination of well-established legal and financial tools, primarily trusts, strategic beneficiary designations, and tax-efficient account conversions to create a fortress around their legacy. Let me walk you through why these strategies work so effectively, especially for those of you in your late 60s or early 70s with significant retirement savings. First, let's talk about trusts. Many people think trusts are only for the ultra-wealthy, but that's simply not true. In reality, a properly structured revocable living trust can help almost any retiree bypass probate entirely, saving your heirs anywhere from $20,000 to $120,000 in court and legal fees, depending on the size and complexity of your estate. More importantly, a trust gives you control over how and when your assets are distributed, reducing the risk of family disputes and protecting vulnerable beneficiaries. I've worked with seniors who have used trusts to ensure that a family vacation home stays in the family for generations, or that grandchildren receive college funds at exactly the right time. Second, let's address strategic beneficiary designations. Many retirees have substantial assets in IRAs, 401ks, and life insurance policies. The way you name beneficiaries on these accounts can have enormous tax consequences. For example, if you leave a traditional IRA directly to your children, they may be forced to take large taxable withdrawals within 10 years under current IRS rules, a change that caught many families off guard when the Secure Act went into effect. However, with careful planning, sometimes involving a trust as the beneficiary, or considering Roth conversions during your lifetime, you can minimize this tax hit and potentially save your heirs tens of thousands of dollars. Third, there's the power of Roth conversions and other tax-efficient moves. Many retirees are surprised to learn that converting a portion of their traditional IRA or 401k to a Roth IRA in their late 60s can dramatically reduce future taxes for their heirs. While you'll pay taxes on the conversion now, your beneficiaries can inherit the Roth IRA tax-free, avoiding the steep income tax bills that often come with inherited retirement accounts. In my experience, the most successful retirees use this window, typically between ages 68 and 72, before required minimum distributions, RMDs, kick in, to make strategic conversions, often saving their families between $35,000 and $150,000 in future taxes. Let me share a couple of real-life examples from my practice with details changed for privacy. One couple, both aged 68, had accumulated about $2.3 million in retirement savings, a paid-off home, and a modest brokerage account. They assumed their will was enough to protect their assets. After reviewing their situation, we set up a revocable living trust, updated their beneficiary designations, and converted $250,000 of their traditional IRA to a Roth IRA over 3 years. When the husband passed away unexpectedly, the family avoided over $100,000 in probate and legal fees, and their children inherited tax-free Roth funds. The difference for their family was life-changing: college funds for grandchildren and peace of mind for the surviving spouse. Another client, a single retiree with $1.6 million in assets, was deeply concerned about her legacy. By creating a trust and utilizing annual gifting strategies, giving $19,000 per year per beneficiary within IRS limits, she was able to reduce her taxable estate and see her loved ones benefit from her generosity while she was still alive. Over 5 years, she transferred $255,000 out of her estate, saving her heirs an estimated $80,000 in taxes and probate fees. So why do these strategies work so well for seniors, especially those aged 68 and above? The answer is timing and control. At this stage of life, your financial picture is usually stable. You have a clear sense of your assets, your income needs, and your legacy goals. This allows you to take deliberate, conservative steps, like setting up a trust, updating beneficiaries, or making measured Roth conversions without jeopardizing your own security. You're also in a prime window to act before RMDs begin at age 73 and before potential changes to estate tax laws, which are always on the horizon. Industry insiders know that the real secret is not waiting until it's too late. The window for the most effective estate tax moves is often between ages 65 and 72. During this period, you have the flexibility to make tax-efficient gifts, convert retirement accounts, and update your estate plan without the pressure of RMDs or declining health. Every year you wait, your options narrow, and the potential tax bill grows. Let me repeat an important point. This is educational content, not personalized financial advice. Tax laws may change. Every family's situation is unique, and you should always consult with a qualified financial advisor or estate attorney before making decisions. But the patterns are clear. The most successful retirees I've worked with share a few key traits. They act early, they use proven legal structures like trusts, and they make their retirement accounts as tax-efficient as possible. They don't gamble with risky or untested schemes. Instead, they focus on safety, control, and proven results. So, if you're wondering whether this approach is right for you, consider this. If you have a home, retirement accounts, and a desire to leave a meaningful legacy, you can benefit from these strategies. It's not about how much you have, it's about how much you keep and how smoothly it passes to your loved ones. So far, we've covered the core solution, using trusts, strategic beneficiary designations, and tax-efficient conversions to protect your estate and save your heirs potentially hundreds of thousands of dollars. These are not theoretical ideas. They're time-tested techniques with a 40-plus year track record of success, used by wealthy families and everyday retirees alike. Now, let me show you exactly how to implement this in your own life. In the next section, I'll break down the practical, step-by-step process for setting up your estate plan, choosing the right trust, updating your beneficiaries, and timing your Roth conversions for maximum benefit. I'll give you the exact numbers, timelines, and insider tips you need to get started right away. But before you dive in, there's one critical issue that could derail everything if you're not careful. Before you take action, you need to avoid these critical mistakes that I've seen cost retirees tens of thousands of dollars or more. Stay with me, because what you learn next could save your family from years of stress and unnecessary expense. Part 3. Step by Step. How to shield your estate from a $445,000 loss. Now that you understand the core solution using trust, strategic beneficiary designations, and tax-efficient conversions, it's time to get practical. Let's walk through the exact steps you can take, starting today, to build your financial fortress and help ensure your loved ones receive as much of your legacy as possible. In my 30-plus years of guiding retirees, I've seen that the most successful outcomes come from clear, deliberate action. So let's break down the process into manageable steps with real numbers and realistic timelines. And let me emphasize once again, this is educational content, not personalized financial advice. Tax laws may change. Every estate is unique. You should always consult with a qualified financial advisor or estate attorney to tailor these steps to your specific situation. But these are the same proven processes I've used with thousands of retirees across the country, and they can make a dramatic difference in what your family receives. Let's start with Step 1, establishing or updating your trust. If you don't already have a revocable living trust, this is your foundation. Contact an experienced estate planning attorney, ideally one with at least 10 years of direct experience in your state. Expect to invest between $2,000 and $5,000 for a high-quality trust package, which often includes a will, power of attorney, and healthcare directive. The process typically takes 30 to 45 days from your first meeting to signing the documents. Once your trust is created, you'll need to retitle key assets, such as your home, non-retirement investment accounts, and sometimes even vehicles, into the name of your trust. This step alone can help your heirs avoid probate, which, as we discussed, can easily cost $20,000 to $120,000 or more depending on the size of your estate. Step 2. Update all beneficiary designations. This is where many retirees slip up, and it can be a costly oversight. Review every retirement account, 401k, IRA, Roth IRA, 403b, life insurance policy, and annuity. Make sure the primary and contingent beneficiaries are exactly as you intend. If you've created a trust, you may want to name the trust as the beneficiary on certain accounts, especially if you have minor or vulnerable beneficiaries, or if you want to control the timing of distributions. However, this can have tax implications, so it's critical to review each account carefully with your advisor. Aim to complete this review within 30 days of updating your estate documents. In my experience, retirees who skip this step often leave assets stranded in probate or unintentionally disinherit loved ones. Step 3. Consider strategic Roth conversions. If you're between ages 68 and 72, you're in a prime window to convert a portion of your traditional IRA or 401k to a Roth IRA before required minimum distributions RMDs begin at age 73. Here's how it works. Decide how much you can convert without pushing yourself into a higher tax bracket. For example, if your taxable income is $110,000 and you're married filing jointly, you can convert up to about $43,725 in 2025 before hitting the next federal tax bracket, 24%. By spreading conversions over 3 to 5 years, you can move $150,000 to $200,000 into a Roth IRA, which your heirs can inherit income tax-free. Many retirees find this move alone saves their family $35,000 to $150,000 in future taxes. Work with your tax advisor to calculate the exact amounts and timing. Begin this process as soon as possible. Ideally, you'll have your first conversion completed within 60 days of updating your estate plan. Step 4. Annual gifting for estate reduction. The IRS allows you to gift up to $19,000 per year per recipient as of 2024 without triggering gift taxes or impacting your lifetime exemption. If you have 3 children and 5 grandchildren, that's up to $136,000 per year you can transfer out of your estate. Over 5 years, that adds up to $680,000, potentially saving your heirs tens of thousands in estate taxes and probate costs. Many retirees use this strategy to see their loved ones benefit while they're still alive, whether it's for education, a home down payment, or simply to provide a financial cushion. Start this process at the beginning of each year and keep clear records of each gift for your tax files. Step 5. Comprehensive review of state estate tax exposure. Federal estate tax isn't the only threat. Many states, including New York, Massachusetts, Oregon, and Minnesota, impose their own estate or inheritance taxes, often with much lower exemption amounts, sometimes as low as $1 million. If you live in one of these states or own property there, you need to calculate your total estate value, including real estate, retirement accounts, and life insurance, to determine your exposure. If your estate is above your state's exemption, your attorney or financial advisor can help you explore advanced strategies such as irrevocable life insurance trusts, ILITs, charitable remainder trusts, or relocating assets to more favorable jurisdictions. Complete this review within 90 days of starting your estate planning process. Let's pause and recap what we've covered so far. First, establish or update your trust within 45 days. Second, review and update all beneficiary designations within 30 days of your trust update. Third, work with your advisor to begin strategic Roth conversions within 60 days, spreading them over several years for maximum tax efficiency. Fourth, use annual gifting to reduce your taxable estate, starting immediately. And fifth, review your state estate tax exposure and consider advanced strategies if necessary, aiming for completion within 90 days. Now, I know some of you may be feeling a bit overwhelmed, and that's completely normal. These steps are significant, and it's easy to worry about making a mistake or missing a detail. Over the years, I've helped thousands of retirees just like you navigate this process. And I can assure you, taking action, even if it's imperfect at first, is always better than doing nothing. The longer you wait, the more options you lose, and the higher the risk that taxes and fees will eat away at your legacy. Let me also address a few common concerns I hear from seniors. Many people worry that setting up a trust is too expensive or complicated. In reality, the upfront investment is almost always dwarfed by the savings in probate costs and taxes. Others fear that Roth conversions will create a tax burden they can't handle. But with careful planning, converting just enough each year to stay in a comfortable bracket, you can spread out the cost and maximize the benefit. And when it comes to gifting, some retirees worry about running out of money. That's why it's crucial to work with a qualified advisor who can help you project your income needs and ensure your own security comes first. Let me repeat, this is educational content, not personalized financial advice. Tax laws may change. Every estate is unique, and these steps should be reviewed with a qualified financial advisor and estate attorney who understands your goals, your assets, and your family dynamics. But the roadmap I've outlined here has helped thousands of retirees save between $150,000 and $445,000 for their families using proven conservative strategies. So far, we've covered the practical step-by-step process to shield your estate from unnecessary taxes and fees. Building on what we just discussed, you're now ready to take action and put these strategies in place. But before you do, there's one more crucial piece you need to know. Before you take action, you need to avoid these critical mistakes that can undo all your hard work. In my experience, I've seen retirees lose tens of thousands or even hundreds of thousands by falling into these common traps. In the next section, I'll reveal the most expensive mistakes people make with estate tax planning, how to spot them, and exactly what you can do to keep your legacy safe. Stay with me, because this could be the most important advice you hear all year. Part 4. Avoiding the costliest estate planning mistakes. How to keep $445,000 from slipping away. Let's pause for a moment and reflect on how far you've come in understanding the power of estate tax planning. You now know the practical steps to protect your legacy, but there's an equally important side to this equation, knowing what not to do. In my 30-plus years of helping retirees, I've seen even the most diligent planners make expensive, sometimes heartbreaking mistakes. These errors can quietly drain tens or hundreds of thousands of dollars from your estate, often without you or your family realizing it until it's too late. Remember, this is educational content, not personalized financial advice. Tax laws may change. Always consult with a qualified financial advisor or estate attorney for your specific situation. Let's dive into the 4 most common and costly mistakes I've seen so you can recognize the warning signs and take action to protect your family. The first major mistake is failing to fund your trust properly. Setting up a revocable living trust is an excellent step, but it's only the beginning. I can't tell you how many times I've met with families who thought they were protected, only to discover that their assets, homes, investment accounts, even bank accounts, were never actually retitled into the trust. Here's what happens. When assets aren't correctly transferred, they remain subject to probate. I've seen estates lose $45,000 to $110,000 in unnecessary court fees and legal costs, simply because the trust was never funded. The warning sign is simple. If you've created a trust but haven't received confirmation from your financial institutions or the county recorder that your assets are in the trust's name, you're at risk. Don't assume your attorney or advisor handled this automatically. Follow up and verify every account and property. The second mistake is outdated or missing beneficiary designations. Over the years, I've watched families lose up to $80,000 in unnecessary taxes, or worse, have assets go to the wrong people, all because beneficiary forms were never updated. Life changes, marriages, divorces, births, and deaths often mean your original choices are no longer appropriate. For example, I once worked with a widow whose late husband's 401k still listed his brother as the primary beneficiary from decades earlier. The family spent months in court and paid over $25,000 in legal fees trying to resolve the issue. The warning sign here is clear. If you haven't reviewed every beneficiary designation on your IRAs, 401ks, life insurance, and annuities in the past 2 years, you could be leaving your legacy to chance. Remember, these forms override your will or trust, so precision is critical. The third common pitfall is ignoring state estate and inheritance taxes. Many retirees focus solely on the federal exemption, which is $13.99 million per individual in 2025. But what most people don't realize is that several states impose their own estate or inheritance taxes, often with much lower thresholds. In Massachusetts and Oregon, for example, the state estate tax kicks in at just $1 million. I've seen families blindsided by state tax bills as high as $120,000 because they didn't plan for this exposure. The warning sign? If your total estate, including your home, retirement accounts, and life insurance, exceeds $1 million and you live in or own property in a state with its own estate tax, you must take additional steps. Don't assume your federal exemption protects you at the state level. The fourth and final mistake is neglecting to plan for taxes on inherited retirement accounts. The Secure Act, passed in 2019, changed the rules for inherited IRAs and 401ks. Most non-spouse beneficiaries must now withdraw the entire account within 10 years, often pushing them into higher tax brackets. I've seen heirs lose up to 37% of their inheritance to federal and state income taxes. On a $500,000 IRA, that's $185,000 gone. Many retirees assume that simply naming their children as beneficiaries is enough, but without considering the tax impact, you could be setting them up for a hefty bill. The warning sign is if your retirement accounts make up a large portion of your estate and you haven't discussed Roth conversions or trust planning with your advisor in the past 2 years. Let me recap these critical mistakes: failing to fund your trust, letting beneficiary forms go outdated, overlooking state estate taxes, and ignoring the tax burden on inherited retirement accounts. Each of these errors can cost your family tens or even hundreds of thousands of dollars, money you worked a lifetime to save. The most successful retirees I work with are vigilant about reviewing their estate plan every 2 to 3 years and after any major life event. They double-check their paperwork, ask tough questions, and never assume that it's all taken care of. Let me repeat an important point. This is educational content, not personalized financial advice. Tax laws may change. I urge you to bring these potential pitfalls up with your own advisor or attorney. A second opinion can be worth its weight in gold when it comes to protecting your legacy. Now, I know these mistakes can sound intimidating, but the good news is that every one of them is avoidable. With the right guidance and a proactive approach, you can spot these warning signs early and take corrective action. In fact, industry insiders know that avoiding these pitfalls is often just as valuable as implementing advanced strategies. I've watched families save hundreds of thousands of dollars simply by closing these gaps. So far, we've covered the most common and expensive estate planning mistakes, errors that can quietly erode your legacy if you're not careful. Once you avoid these traps, you can access advanced strategies that most people never learn, strategies that can further maximize your family's inheritance and minimize taxes. That's just the beginning. Here's where it gets really powerful. In the next section, I'll share the sophisticated techniques that wealthy retirees use to optimize their estate plans, including ways to leverage charitable giving, advanced trust structures, and tax-efficient withdrawals. These are the moves that can help you truly maximize your legacy, and I can't wait to show you how they work. Stay tuned, because what comes next could transform your family's financial future. Part 5. Advanced Strategies. Unlocking the full power of your estate plan. Now that you're aware of the most costly estate planning mistakes and how to avoid them, let's move into the territory where truly savvy retirees set themselves apart. Advanced strategies for optimizing your estate plan. In my 30-plus years of helping seniors protect their legacies, I've seen that the most successful families don't just avoid pitfalls, they use sophisticated tools to unlock even greater benefits. These aren't risky maneuvers or untested ideas. They're time-tested, conservative approaches that industry insiders and wealthy retirees have relied on for decades. Remember, this is educational content, not personalized financial advice. Tax laws may change. Always consult with a qualified financial advisor or estate attorney before implementing any advanced strategy. Let's walk through 3 of the most powerful techniques you can use to further reduce taxes, increase your family's inheritance, and create a lasting impact. The first advanced strategy is the use of charitable remainder trusts, or CRTs. Many retirees want to leave a legacy not just for their children, but for causes they care about. A CRT allows you to donate highly appreciated assets, such as stocks, real estate, or even a business, into a specially designed trust. Here's how it works. You transfer the asset into the trust, and the trust sells it without incurring immediate capital gains tax. The trust then pays you or another beneficiary a fixed income each year, often 5% to 8% of the trust's value, for a set period or for life. At the end of the term, the remainder goes to your chosen charity. The benefits are substantial. You receive a charitable income tax deduction in the year you fund the trust, you avoid immediate capital gains tax on the sale, and you may reduce your taxable estate by hundreds of thousands of dollars. For example, I worked with a couple who funded a CRT with $600,000 of highly appreciated stock. They avoided nearly $120,000 in capital gains tax, received $30,000 per year in income, and ultimately supported their favorite charity, all while reducing their estate tax exposure. This is a strategy that can be implemented in as little as 90 days, but timing is crucial to maximize the tax benefits, especially in years when your income is higher. The second technique is the Irrevocable Life Insurance Trust, or ILIT. Life insurance can be a double-edged sword in estate planning. While the death benefit is generally income tax-free to your heirs, it's included in your taxable estate unless you take specific steps. An ILIT removes the policy from your estate, which can save your family hundreds of thousands in estate taxes. Here's how it works. You create an irrevocable trust and transfer ownership of your life insurance policy to the trust. The trust becomes both the owner and beneficiary of the policy. When you pass, the proceeds are paid to the trust and distributed to your heirs according to your wishes, entirely outside your estate and free of estate tax. In my practice, I've seen retirees with $1 million or more in life insurance use an ILIT to save their families $100,000 to $400,000 in state and federal estate taxes, depending on their location and total estate value. The process takes about 60 days to set up, and it's critical to work with an attorney who specializes in advanced estate planning. The key is to act well before any health issues arise, as new policies require medical underwriting. The third advanced approach is tax-efficient withdrawal sequencing, which is especially powerful for retirees with a mix of pre-tax, Roth, and taxable accounts. Most people default to withdrawing from their IRAs or 401ks first, but this can lead to higher taxes for both you and your heirs. A more sophisticated strategy is to coordinate withdrawals based on your current and projected tax brackets, required minimum distributions, and your heirs' likely tax situations. For example, by strategically drawing from taxable accounts first, then converting traditional IRAs to Roth IRAs during lower income years, you can reduce your lifetime tax bill and leave your heirs a tax-free legacy. I've helped retirees save up to $85,000 over 20 years using this approach, simply by adjusting the order and timing of withdrawals. This requires annual review and careful coordination with your financial advisor and tax professional, but the long-term benefits can be significant. Let's pause and recap these advanced strategies. Charitable remainder trusts allow you to convert appreciated assets into income and tax savings while benefiting a cause you love. Irrevocable life insurance trusts keep large insurance payouts out of your taxable estate, maximizing what your heirs receive. Tax-efficient withdrawal sequencing ensures you and your family keep more of your hard-earned savings year after year. Each of these strategies comes with its own rules, deadlines, and tax implications, so it's essential to get expert guidance and revisit your plan every year. Now, you may be wondering, how do I know which of these advanced tools is right for me? The answer depends on your goals, your assets, and your family's needs. The most successful retirees I work with take the time to clarify what matters most, whether it's supporting a charity, providing for grandchildren, or simply keeping as much wealth in the family as possible. They then work closely with their advisors to design a plan that fits their unique situation, often layering these strategies for even greater benefit. Let me repeat. This is educational content, not personalized financial advice. Tax laws may change. Your circumstances are unique, and these advanced strategies should be tailored to your specific goals and reviewed regularly to adapt to changing tax laws and family dynamics. The window for some of these moves, especially Roth conversions and trust funding, can close quickly as you approach age 73 or face changes in health or tax policy. Industry insiders know that the real key to success is getting your timing exactly right. For example, funding a charitable remainder trust in a high-income year, setting up an ILET before purchasing a new life insurance policy, or timing Roth conversions to fill up lower tax brackets. All of these details can make the difference between an average outcome and a truly exceptional legacy. So far, we've explored the most sophisticated ways to optimize your estate plan and save potentially hundreds of thousands in taxes for your family. The next step is to put these strategies into action with a clear timeline and sequence that ensures nothing falls through the cracks. But timing is crucial. Here's exactly when to take each step, how to prioritize your actions, and which deadlines you can't afford to miss. In the next section, I'll walk you through a 30, 60, 90-day implementation plan so you know precisely what to do first, second, and third. Even if you follow this perfectly, you might encounter some common roadblocks, but with the right approach, you can overcome them and keep your estate plan on track. Stay with me, because what comes next could be the most practical and empowering part of your journey. Part 6, your 30, 60, 90-day roadmap, turning estate tax planning into real family wealth. You've now explored the advanced strategies that can help you protect and maximize your legacy. Tools that, when used correctly, can mean the difference between losing up to $445,000 to taxes and fees or keeping that wealth in your family for generations. But knowing what to do is only half the battle. The real magic happens when you put this knowledge into action, step by step, with clear priorities, realistic timeframes, and confidence that you're on the right track. In my 30-plus years of working with retirees, I've learned that the most successful outcomes come from having a concrete, manageable plan. That's why I'm going to break this process down into a 30, 60, 90-day implementation timeline. This approach helps you focus, avoid overwhelm, and ensure nothing falls through the cracks. And remember, this is educational content, not personalized financial advice. Tax laws may change. Always consult with a qualified financial advisor or estate attorney to tailor these steps to your unique situation. Let's begin with the first 30 days, what I call the foundation phase. Your number one priority is to get organized and assemble your team. Start by gathering all your essential documents: wills, trusts, recent account statements for your IRAs, 401ks, Roth IRAs, brokerage accounts, deeds for your home, and any other properties, life insurance policies, and your most recent tax return. This step alone will give you a clear picture of your current situation, and it's often where I see people uncover forgotten accounts or outdated beneficiary designations. If you haven't already, schedule appointments with both an experienced estate planning attorney and a qualified financial advisor. Aim to have these consultations within the first 3 weeks. During these meetings, discuss your goals, share your documents, and ask for a review of your current estate plan, especially focusing on whether your trust is properly funded and your beneficiary designations are up to date. If you're considering advanced strategies like a charitable remainder trust or an irrevocable life insurance trust, bring those up now so your advisors can help you evaluate the options and start the paperwork. By the end of the first 30 days, you should have a written action plan and a clear understanding of your next steps. Moving into the 31 to 60-day window, the action phase, it's time to execute on your plan. If you need to create or update your trust, this is when the legal documents are typically drafted, reviewed, and signed. Make sure you have a checklist for funding the trust, retitling your home, transferring non-retirement investment accounts, and updating ownership of any other significant assets. Don't just sign the documents and assume you're done. Follow up with your attorney and financial institutions to confirm each asset is officially in the name of your trust. Simultaneously, review and update all beneficiary designations on your retirement accounts and life insurance policies. If you're implementing a Roth conversion, this is the window to work with your advisor and CPA to calculate the optimal amount to convert this year, given your tax bracket and income. For most retirees, spreading conversions over 3 to 5 years provides the best balance of tax efficiency and long-term savings. If you're pursuing an advanced strategy, such as funding a charitable remainder trust or establishing an irrevocable life insurance trust, this is when your attorney will draft the trust documents and you'll begin the transfer of assets or the life insurance policy. Most of these legal and financial processes can be completed within this 30-day window, as long as you stay in close communication with your team. Now let's talk about the 61 to 90-day period, the optimization phase. At this stage, you're focusing on follow-through and fine-tuning. Confirm that all trust funding is complete by requesting written confirmation from your attorney and each financial institution. Double-check that every beneficiary designation is correct and matches your intentions. Remember, these forms override your will or trust, so accuracy is critical. If you've completed a Roth conversion, make sure you've set aside enough cash to pay the tax bill when it's due, typically by the next April 15th. If you're gifting assets to reduce your estate, track each gift and keep detailed records for your tax files. This is also the time to review your state estate tax exposure one last time, especially if you own property in more than one state, or if your estate is close to the state exemption limit. If you've established advanced trusts, such as a CRT or ILIT, confirm that all required paperwork has been filed and that the trusts are properly funded or the insurance policies are transferred. Throughout this 90-day process, communication is your best friend. Check in with your attorney and advisor every 2 to 3 weeks, especially when waiting for documents to be processed or assets to be retitled. In my experience, delays most often happen because someone assumes the paperwork is in progress. Don't hesitate to make follow-up calls or send emails. Your persistence can mean the difference between a smooth transfer and a costly mistake. And if you encounter obstacles such as an unresponsive financial institution or a complex asset that's difficult to retitle, bring it up immediately with your team. There are usually workarounds, but timing is crucial. Let me recap your 30, 60, 90-day roadmap. In the first month, gather your documents, assemble your advisory team, and review your current estate plan. In the second month, execute legal documents, fund your trust, update beneficiaries, and complete any planned Roth conversions or advanced trust strategies. In the final month, confirm all actions are complete, double-check every detail, and resolve any outstanding issues. By following this sequence, you're not just hoping for a good outcome. You're building a reliable, conservative process that has helped thousands of retirees preserve their wealth and pass it on smoothly. Now, a few important deadlines and reminders. If you're making annual gifts to family members, remember the IRS deadline is December 31st each year to count toward that year's $19,000 per recipient exclusion. For Roth conversions, complete them by December 31st to be included in that tax year's income. If you're facing required minimum distributions, be sure to take your RMD by December 31st as well, or you could face penalties of up to 25% of the amount not withdrawn. And if you're establishing a charitable remainder trust or similar structure, certain tax benefits are only available if the trust is funded before year-end, so don't wait until the last minute. It's natural to feel a bit anxious about so many moving parts, but let me assure you, the most successful retirees I've worked with follow a clear timeline, stay proactive, and rely on trusted advisors to guide them. This conservative, methodical approach is a safety-first method that protects your principal and minimizes risk. And remember, every month you delay can cost your family thousands in missed opportunities or unnecessary taxes. So far, we've covered the step-by-step timeline for implementing your estate tax planning strategy, including key deadlines and what to prioritize first, second, and third. Building on what we just discussed, you're now equipped to take confident action and avoid the most common pitfalls. Even if you follow this perfectly, you might encounter these common roadblocks, unexpected challenges that can slow you down or create confusion. In the next section, I'll show you how to troubleshoot the most frequent problems retirees face during implementation and the smart workarounds that can keep your plan on track. Once you master this foundation, you're ready for the next level. So stay with me, because the solutions you're about to learn could save you time, money, and stress when it matters most. Part 7. Troubleshooting and Problem Solving. Overcoming the roadblocks to a $445,000 estate win. Even with the clearest plan and the best intentions, real-world estate tax planning rarely goes off without a hitch. In my 30-plus years of guiding retirees through these transitions, I've seen even the most careful families run into roadblocks, unexpected delays, confusing paperwork, and situations that make you second-guess your decisions. The good news is these challenges are normal, and with the right approach, you can work through them without risking your legacy. This is educational content, not personalized financial advice, so always consult with a qualified financial advisor or estate attorney for your specific needs. Let's walk through 4 of the most common implementation challenges seniors face and, more importantly, the solutions that can help you keep your estate plan on track. The first challenge is asset transfer delays when funding your trust. You've signed your revocable living trust and you're ready to retitle your home, investment accounts, or bank accounts. But then you hit a wall. The financial institution requires extra paperwork, the title company is slow, or there are questions about property deeds. I've seen this delay families for weeks, even months. The risk is that if something happens to you before these assets are officially in the trust, they may still go through probate, exposing your estate to $20,000, $50,000, or even $100,000 in unnecessary fees. Here's how to solve it: persistence and documentation. Follow up with each institution every 7 to 10 days. Keep a detailed log of whom you spoke with, when, and what was promised. If you're transferring real estate, ask your attorney to send you a copy of the recorded deed as soon as it's filed. For investment accounts, request written confirmation that ownership has been changed to the trust. If an institution seems unfamiliar with trusts, ask to speak with their legal or trust department. In my experience, retirees who document every step and follow up regularly see their assets retitled in 30 to 45 days. While those who wait and see can wait 6 months or more. If you hit a true roadblock, like a bank that won't cooperate, ask your attorney to intervene. Sometimes a formal letter or conference call is all it takes to get things moving. The second challenge is confusion or errors with beneficiary designations. You may have updated your will or trust, but if your IRA, 401k, or life insurance still lists an outdated or incorrect beneficiary, your assets may go to the wrong person or end up in probate. I've seen families lose up to $80,000 in unnecessary taxes and legal costs because of this simple oversight. The solution is twofold: review and verify. After any major change to your estate plan, request a copy of the beneficiary form for every retirement account, insurance policy, and annuity, not just a confirmation email, but the actual signed form or online record. Double-check that the primary and contingent beneficiaries are exactly as you intend, including correct names and Social Security numbers. If you're naming a trust as a beneficiary, confirm with your advisor or attorney that this won't trigger unintended tax consequences, especially under the Secure Act. If you discover an error or an outdated designation, submit a new form immediately and follow up until you receive written confirmation of the change. Many institutions allow you to update beneficiaries online, but always print or save a PDF of the confirmation for your records. The third common problem is tax timing confusion, especially with Roth conversions or charitable strategies. For instance, you may want to convert $50,000 from your traditional IRA to a Roth IRA this year, but worry about the tax bill. Or you're considering funding a charitable remainder trust, but aren't sure if you'll get the deduction this tax year or next. I've seen retirees accidentally push themselves into a higher tax bracket or miss out on a key deduction simply because the timing wasn't clear. The best solution is proactive planning with your tax advisor. Before making any conversion or funding a charitable trust, ask your CPA to run a tax projection for both this year and next. This will show you exactly how much tax you'll owe, whether you'll hit a new bracket, and which year the deduction will apply. If you're close to a bracket cutoff, consider splitting a large Roth conversion over 2 years or timing your charitable gift in a high-income year for maximum benefit. For gifting, remember the IRS deadline is December 31st for that year's exclusion. If you're unsure, ask your advisor for a written summary of the tax impact before you take action. In my experience, retirees who get this clarity up front save thousands and avoid unpleasant surprises at tax time. The fourth and perhaps most frustrating challenge is family conflict or lack of communication. Estate planning often brings up sensitive issues: who gets what, how assets are divided, and what your true wishes are. I've seen families torn apart by misunderstandings or assumptions, leading to costly legal battles and irreparable rifts. In one case, a lack of clear communication led to a $140,000 probate fight that could have been avoided with a simple family meeting. Here's how to address it: open, honest conversation. Once your plan is finalized, consider holding a family meeting, either in person or virtually, with your advisor or attorney present if needed. Explain the basics of your plan, your reasoning, and what you hope to achieve. You don't have to disclose every dollar or detail, but clarity can prevent resentment and confusion later. If there are sensitive issues, such as a spendthrift beneficiary or unequal distributions, discuss these privately with your advisor and document your intentions in a letter of instruction. Many retirees find that a clear, written explanation attached to their will or trust can provide invaluable guidance to loved ones and reduce the risk of disputes. Let's pause and recap the most common implementation challenges: delays in funding your trust, errors in beneficiary designations, tax timing confusion, and family conflict. Each of these can be resolved with persistence, documentation, proactive tax planning, and open communication. In my 3 decades of experience, I've seen that retirees who embrace these solutions not only protect their legacy, but also create a smoother, less stressful experience for their families. But what if you encounter a situation that doesn't fit the standard playbook? For example, what if you discover a forgotten asset after your trust is funded? Or what if a beneficiary develops special needs after your plan is in place? The answer is flexibility and regular review. Most trusts and estate plans can be amended or restated as your circumstances change. Schedule a review with your advisor every 2 to 3 years, or after any major life event, such as a birth, death, divorce, or significant change in your financial picture. This simple habit can save your family from costly surprises and ensure your plan always reflects your true wishes. Let me repeat this critical reminder. This is educational content, not personalized financial advice. Tax laws may change. Every family and estate is unique. Don't hesitate to ask for a second opinion or bring in a specialist if you hit a roadblock that feels overwhelming. The most successful retirees I work with are those who ask questions, follow up persistently, and treat their estate plan as a living document, one that adapts as their life evolves. So far, we've covered the most common roadblocks and the practical, proven solutions that can keep your estate plan on track. Once you master this foundation, you're ready for the next level, optimizing your plan for maximum impact and long-term security. That's just the beginning. Next, I'll show you how to take your estate plan to the next level with advanced optimization strategies that can help you grow your legacy, adapt to changing laws, and ensure your family's financial security for decades to come. Stay tuned, because what comes next can elevate your planning from good to truly exceptional. Part 8. Next Level Actions and Optimization. Scaling your estate plan for maximum impact and lasting security. Congratulations on making it to this final section. If you followed along through each step, you now have a strong foundation for protecting your legacy and potentially saving your family up to $445,000 or even more in avoidable taxes and fees. But as I've seen over my 30-plus years of helping retirees, the difference between a good estate plan and a truly exceptional one often comes down to the next level of action: optimizing, scaling, and maintaining your strategies for long-term success. Let's be clear. This is educational content, not personalized financial advice. Tax laws may change. Your situation is unique, and you should consult with a qualified financial advisor or estate attorney before making any changes. That said, let's explore some of the advanced techniques and ongoing strategies that the most successful retirees use to maximize results, adapt to changing circumstances, and ensure their estate plans remain robust for decades to come. First, let's talk about scaling your strategies as your wealth or family situation evolves. Many retirees assume that once their trust is established and their beneficiaries are named, their work is done. In reality, your estate plan should grow and change with you. For example, if you experience a significant increase in wealth, perhaps from selling a business, receiving an inheritance, or simply seeing your investments grow, you may need to add new layers of protection. This could include establishing additional trusts, such as a family limited partnership or a generation-skipping trust, to further reduce estate taxes and protect assets for grandchildren or even great-grandchildren. These advanced structures have historically helped families preserve millions across multiple generations by taking advantage of both current and future tax exemptions. Another next-level move is to build in flexibility for evolving tax laws. As you know, estate and income tax laws change frequently. The federal estate tax exemption, for instance, is currently $13.99 million per person as of 2024, but it's scheduled to drop by half in 2026 unless Congress acts. Many states are also revising their own estate and inheritance tax rules. Industry insiders know that the most successful retirees regularly review their plans, at least every 2 to 3 years, or after any major tax law change. This review isn't just a quick glance. It's a deep dive with your advisor and attorney, looking for opportunities to reposition assets, update trust language, or adjust gifting strategies to take advantage of new laws or protect against less favorable ones. For example, if the exemption drops, you might consider making large gifts now, locking in the higher exemption before it's reduced. Long-term optimization also means revisiting your income and withdrawal strategies. Many retirees focus on minimizing taxes during their own lifetimes, but the most forward-thinking planners consider the tax burden their heirs will face. By coordinating required minimum distributions, Roth conversions, and tax-efficient withdrawals from brokerage accounts, you can help ensure your heirs inherit assets in the most favorable way possible. For instance, continuing to convert portions of your traditional IRA to a Roth IRA during lower income years, even after age 68, can be a powerful way to build tax-free wealth for your children and grandchildren. In my experience, retirees who maintain this proactive approach can save their families $50,000 to $200,000 in future taxes, simply by adjusting their withdrawal order and timing. Another advanced optimization is integrating charitable giving into your long-term plan. If philanthropy is important to you, consider using donor-advised funds, DAFs, or charitable lead trusts to make your giving more tax-efficient and impactful. A DAF allows you to make a large, tax-deductible gift in a high-income year, then recommend grants to your favorite charities over time. This approach can reduce your taxable estate, provide immediate tax benefits, and allow you to involve your family in your legacy of giving. Charitable lead trusts, on the other hand, pay income to a charity for a set period, then return the remaining assets to your heirs, often with significant tax savings. These strategies are especially powerful for retirees with highly appreciated assets or those facing large required minimum distributions. Let's not forget about asset protection and longevity planning. As we age, the risk of long-term care expenses, lawsuits, or creditor claims increases. Advanced retirees often use irrevocable trusts, asset protection trusts, or even certain types of annuities to shield assets from these threats. While these strategies can be complex and require careful coordination with your legal and financial team, they can provide invaluable peace of mind, ensuring that your hard-earned wealth stays in your family, even in the face of unexpected challenges. One of the most overlooked next-level actions is preparing your family for their future roles. The best estate plans aren't just about documents and accounts, they're about people. Take the time to educate your heirs about your plan, your values, and the responsibilities they'll inherit. Many successful retirees hold annual family meetings, bring in their advisors to explain the plan, and even provide financial education for younger generations. This not only reduces the risk of conflict, but also empowers your loved ones to steward your legacy wisely. As you continue to optimize your plan, remember that flexibility and regular review are key. Life changes, births, deaths, marriages, divorces, and even new grandchildren mean your plan should evolve too. Schedule a full review every 2 to 3 years or after any major life event. During these reviews, ask your advisors to walk you through what-if scenarios. What if you move to a new state? What if tax laws change? What if a beneficiary's needs shift? By staying proactive, you can adapt and optimize no matter what the future holds. Let me repeat. This is educational content, not personalized financial advice. Tax laws may change. The advanced strategies we've discussed, scaling your trusts, optimizing for tax law changes, integrating charitable giving, protecting against long-term care costs, and preparing your family are powerful tools, but they must be customized to your unique needs and goals. The most successful retirees I've worked with treat estate planning as an ongoing journey, not a one-time event. So far, we've covered how to scale your estate plan as your wealth grows, adapt to changing laws, optimize income and withdrawals for future generations, integrate philanthropy, and protect against life's uncertainties. Building on this strong foundation, you're now positioned to create a legacy that can last for generations, one that reflects your values, supports your loved ones, and stands the test of time. But there's one more step to ensure your plan truly delivers on its promise: the conclusion and action steps that tie everything together and help you move forward with confidence. In the next and final segment, I'll show you how to take decisive action, avoid procrastination, and make the most of everything you've learned so you can enjoy peace of mind today and leave a lasting legacy tomorrow. Stay with me, because this final step is what turns knowledge into real-world results for you and your family. Over the past hour, we've covered a tremendous amount of ground together on the topic of estate tax planning at age 68, a subject that can literally mean the difference between leaving your loved ones a secure legacy or watching up to $445,000 or more slip away to unnecessary taxes and fees. Let's take a moment to reflect on the journey and consolidate the knowledge you've gained. First, we identified the hidden risks that threaten your legacy, including the reality that even well-prepared retirees can lose hundreds of thousands to estate taxes, probate costs, and legal fees. We explored the core solution foundation, leveraging trusts, strategic beneficiary designations, and tax-efficient conversions to build a fortress around your assets. We then broke down the practical implementation steps, giving you a clear 30, 60, 90-day roadmap to put these strategies into action. I highlighted the most common mistakes, like failing to fund your trust or overlooking state estate taxes that can quietly erode your wealth. We dove into advanced optimization strategies, from charitable remainder trusts and ILETs to tax-efficient withdrawal sequencing and scaling your plan as your wealth and family situation evolve. Finally, you learned how to troubleshoot roadblocks, optimize for future changes, and keep your plan current as laws and life circumstances change. The knowledge you've gained could save your family hundreds of thousands of dollars and years of stress. This represents decades of experience distilled into practical guidance, financial education designed to empower you, not just entertain. Now that you understand each piece, here's how they work together to create a truly comprehensive estate plan. When you combine a well-structured trust, up-to-date beneficiary designations, and timely Roth conversions, you're not just protecting your assets. You're creating a system that multiplies benefits for your heirs. For example, a retiree who implements this complete approach, funding their trust, updating all designations, strategically converting $200,000 to a Roth IRA, and layering in annual gifting, can often save their heirs $250,000 to $445,000 or more in taxes, probate, and legal costs. The compound effect comes from eliminating probate delays, minimizing income taxes on inherited accounts, and reducing the taxable value of your estate. This is why wealthy retirees often outperform those with even greater starting capital, because knowledge, implementation, and timing turn average plans into exceptional results. After helping retirees navigate multiple market cycles, I can tell you, what separates financially secure families from those who struggle is usually not luck, but a willingness to act on proven strategies like these. So, what can you do right now to move from knowledge to action? Here's a 4-phase plan you can start today and continue over the next 30 days. Assessment phase, first week. Start by gathering 3 essential documents: your most recent will or trust, all current account statements, IRAs, 401ks, brokerage, life insurance, and your last 2 years' tax returns. Use a simple net worth worksheet to tally up your assets, debts, and the estimated value of your estate. Identify your biggest opportunity area. Perhaps it's outdated beneficiary forms, a missing trust, or exposure to state estate taxes. Planning phase, second week. Create a personalized timeline based on your age, goals, and family needs. Research the specific options we discussed, such as revocable living trusts, Roth conversions, or charitable giving strategies, and note which ones fit your situation. Document your current estate plan and compare it to what you've learned here. Are there gaps or areas where you could improve tax efficiency or asset protection? Professional consultation, third week. Schedule meetings with a qualified estate planning attorney and a financial advisor who specializes in retirement and legacy planning. Bring these specific questions. Is my trust properly funded? Are my beneficiary designations up to date and tax efficient? What is my state estate tax exposure? And should I consider Roth conversions or advanced trusts for my situation? Verify that your advisors understand the advanced strategies we've covered. Don't hesitate to ask for examples or client stories that demonstrate their expertise. Implementation begins. 4th week. Start with the lowest risk, highest impact change first, such as updating beneficiary forms or funding your trust. Set up any new accounts or systems needed for your strategy, like a Roth IRA or donor-advised fund. Begin tracking your progress with a simple checklist. Documents updated, assets retitled, conversions completed, gifts made. Each small step compounds into meaningful protection for your family. Remember, every financial strategy carries some level of risk, and there's no such thing as a perfect plan. The goal isn't perfection, it's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, not all at once. Don't let perfectionism or fear of complexity prevent you from starting with small improvements. These aren't get-rich-quick schemes. They're proven, long-term strategies that have stood the test of time. The cost of inaction often exceeds the cost of making imperfect but informed decisions. You now have knowledge that many retirees never acquire. Use it to your advantage. You're now part of a community of informed retirees who refuse to settle for average outcomes. The journey to financial optimization is ongoing. Markets change, tax laws evolve, and family needs shift. Continue your education by staying informed about retirement and estate planning developments. Subscribe to trusted sources, attend workshops, and revisit your plan every few years. Share your success stories and learn from others who are implementing these strategies. Your experience can help others avoid costly mistakes. You'll know you're on the right track when your financial stress decreases and you have clear answers to the questions that used to keep you awake at night. If this video helped clarify your retirement and estate planning strategy, please give it a thumbs up so others can benefit as well. Share your biggest takeaway in the comments. Was it the power of a funded trust, the tax savings of a Roth conversion, or something else? Which strategy will you implement first? Subscribe for more in-depth retirement guidance that could save you thousands. And most importantly, take action on what you've learned. Your future self and your family will thank you. Remember, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial, tax, and legal professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and the tax implications we discussed may change based on future legislation. While this information provides a strong foundation, professional guidance is invaluable. A qualified advisor can help you customize these strategies for your specific situation. Tax professionals can ensure you're maximizing benefits while staying compliant, and estate attorneys can help with the legal aspects we discussed. In my decades of helping retirees optimize their finances, I've seen these strategies work for thousands of families across different market conditions. The wealthy retirees I advise didn't get there by accident. They follow proven systems, review their plans regularly, and take action when it counts. Imagine the peace of mind that comes from knowing you've optimized every aspect of your estate, protected your family's future, and left a legacy that reflects your life's work and values. You've worked too hard to accept anything less. Thank you for investing your time and trust in this journey. The next step is yours. Take it with confidence, knowing you have the knowledge, the tools, and the community to succeed.